Most people find out their credit score is bad at the worst possible moment, not when they have time to fix it, when they're sitting across from a landlord or waiting on a loan approval. That number on the screen felt random, like something that happened to them. But credit scores don't just appear. They're built, quietly, from specific financial behaviors over time. The problem is almost nobody explained the actual mechanism. They got told pay on time and don't max out your card. And that was it. So when the score doesn't move, or drops for no obvious reason, people assume the system is broken. Sometimes it is frustrating, but mostly it's following rules you weren't given clearly. There are 5 things feeding into your credit score right now, and they don't all matter equally. Payment history is the biggest one. It accounts for roughly 35% of most standard scoring models. One missed payment doesn't quietly disappear. It can sit on your report for 7 years. Not every missed payment hits the same way. A 30-day late is different from a 90-day late. But either way, the damage is real, and it compounds with anything else going wrong at the same time. The second factor is credit utilization. How much of your available credit limit you're actually using. If your card limit is $2,000 and you're carrying $1,400, that's 70% utilization. Most scoring guidance suggests keeping it under 30%. Under 10% tends to score even better. What a lot of people miss. Utilization is usually measured at the statement date, not the due date. So paying off the full balance after the due date doesn't always help your utilization on that month's report. The card issuer may have already reported the high balance to the bureaus before you paid. That's a timing issue most people never figure out until they've been doing it wrong for years. The third factor is length of credit history. How long your accounts have been open on average. This is why closing an old card, even one you don't use, can sometimes pull your score down. That card might be the oldest account on your report, and removing it shortens your average history. The fourth factor is credit mix. Whether you have different types of credit or just one kind, a credit card, a car loan, a student loan. That variety signals different kinds of repayment behavior. You don't need every type, but having only one kind of account limits how the score can grow. The fifth factor is new credit inquiries. Every time you apply for credit, a hard inquiry is recorded. One inquiry matters very little. Several in a short window can signal financial stress to lenders. Rate shopping for a mortgage or auto loan is treated differently. Multiple inquiries in a short period often count as one. But applying for 4 credit cards in 2 months doesn't get that same grouping. Now here's where most people go wrong when trying to fix a bad score. They focus almost entirely on the future and ignore what's currently dragging them down on the report. Your credit report and your credit score are 2 different things, and that distinction matters a lot. The score is the number. The report is the full history the number is calculated from. You can get your credit report from all 3 major bureaus for free, and you should actually read it, not skim it. Look at every account, every balance listed, every payment status. Errors on credit reports are more common than most people expect, and they can be disputed. A collection account that isn't yours, a payment marked late that wasn't, a balance that's wrong. These are disputable. The bureaus are required to investigate disputes, and if they can't verify the item, it has to be removed. That's not a loophole. That's how the system is supposed to work. Some people spend months trying to build new positive history, while an error is silently tanking the score underneath. Fix what's wrong on the report first, then focus on building from there. The second mistake is trying to open new credit accounts to build credit faster. Adding new accounts does add available credit, which can help utilization, but it also adds hard inquiries and lowers average account age. If you're already in a rough spot, that trade-off often isn't worth it in the short term. The smarter move in many cases is to focus on the accounts you already have and use them better. A secured card, where you deposit money as the credit limit, can work for people starting from scratch. But the goal isn't the card itself. The goal is the payment history it builds over 12 to 18 months. One thing that actually moves the score faster than most people expect, bringing down utilization quickly. If you can pay a high balance down significantly before the statement date, the score can respond within a billing cycle. Not always, not guaranteed. But utilization is one of the few factors that can shift in weeks, not years. Payment history, by contrast, takes time. You can't undo a 90-day late mark. You can only let it age. A negative item loses some of its weight over time, especially as positive history builds up around it. 7 years feels like forever. But a 3-year-old late payment on an otherwise clean recent history matters less than it did on day 1. There's an entire industry built around people who are desperate to fix their credit fast. Credit repair companies charge monthly fees, sometimes hundreds of dollars, to do things you can do yourself for free. They'll dispute items on your behalf, write letters, follow up with bureaus. All of that is real work, but none of it requires paying someone else to do it. The bureaus have online dispute processes. You can write a dispute letter yourself in under an hour. What these companies can't do, despite what some of their ads imply, is remove accurate negative information. If you genuinely missed payments, those are yours. No service can legally erase accurate history early. Some of them promise things that aren't possible, and people in financial stress are exactly who those promises target. If someone is offering to give you a new credit identity or a fresh file, that's fraud. Walk away. There's also a version of this that gets marketed as a credit privacy number or CPN. It's illegal. People have faced federal charges for using one. It sounds like a product. It isn't. The path to better credit is slower than the ads suggest and more manageable than the situation feels. For most people in a bad credit situation, the realistic timeline to meaningful improvement is 12 to 24 months, not weeks, not 90 days, despite what some programs claim. If there are collections on the report, the question of whether to pay them is more complicated than it sounds. Paying an old collection doesn't always remove it from the report. It often just updates it to paid collection. In some scoring models, a paid collection still weighs on the score. In newer models, it matters less. Before paying an old collection, it's worth checking whether the debt is past the statute of limitations in your state. That affects whether a collector can legally sue to collect. It doesn't affect the credit report timeline, but it changes the risk picture. This is one of those areas where getting specific legal information relevant to your situation actually matters. Speaking generally, older collections that are close to falling off the report in a year or two are a different calculation than fresh ones. There's no universal right answer. It depends on the debt age, the amount, the scoring model your lender uses, and what you're trying to qualify for. What does consistently help across almost every situation? On-time payments? Every month, without exception. Not most months, every month. Even the minimum payment keeps the account current and protects payment history. A lot of people in debt stop paying because they feel overwhelmed and don't know where to start. That pause, even a short one, can trigger late marks that set the recovery back significantly. If cash is tight, paying the minimum on everything is better than paying one thing in full and missing another. Protecting existing positive history is just as important as building new history. Another thing worth knowing: becoming an authorized user on someone else's account can help in some situations. If a family member has an old account with a clean history and low utilization, being added can reflect on your report. You don't need to use the card. In many cases, the account history shows up and helps your average age and utilization. It's not a magic fix, and it depends on the card issuer reporting authorized users to the bureaus. Not all do. But for someone trying to establish or rebuild, it's one of the lower effort options that can genuinely move the number. What most people underestimate is how much the score matters beyond just loan approvals. Landlords check it. Some employers in certain industries check it. Insurance premiums in many states are partially tied to it. A poor credit score can cost real money every month in ways that have nothing to do with debt. Higher car insurance rates, a larger security deposit, a higher interest rate on a car loan, these are ongoing costs. The gap between a 620 score and a 740 score on a mortgage can mean tens of thousands of dollars over the life of the loan. That's not a hypothetical. That's how lenders price risk, and the pricing is significant. So the motivation to fix a bad score isn't just about getting approved. It's about what approved actually costs you. Most people who've improved their credit look back and realize the process wasn't complicated once they understood it. It was just slow, and they didn't have a clear map of what was actually hurting them versus what they assumed was hurting them. Pull the report. Find the actual problems. Dispute errors first. Bring utilization down where possible. Protect every current account by paying on time, even minimally. Let negative items age while positive history builds. Don't pay for services that do what you can do yourself. Don't fall for timelines that don't exist. And don't confuse a low score with a permanent condition. It isn't. It's a lagging indicator of past behavior. The score follows what you actually do with credit over time. Change the behavior. The number eventually follows. The one question worth sitting with before you close this: do you actually know what's on your credit report right now? Not what you assume is there. What's actually listed. Account by account, balance by balance, status by status. Most people don't, and that's usually where the gap between where the score is and where it could be begins.